I think we can go ahead and get started, and people can join as they're able. So hello everyone. I'll start by introducing myself. So my name is Ivory Becker. I'll talk a little bit more about my history, why we're here, who I am, why I'm talking today in a moment. But I do want to say that we want this to be interactive. We're all here representing the real estate side, credit repair side, and then the lending space as well, the mortgage lending space. So we are here to answer your questions. Today's area of focus is credit, but we definitely don't want to discourage you from any questions that you have. As you have questions, feel free to chime in by either unmuting yourself or using the chat. So either option's fine, whatever you're most comfortable with. We will have open Q&A at the end as well. And the whole point of this is for it to be beneficial. So again, like I said, today is going to be more credit focused, but chime in as you have any other questions. With that, I'm going to go ahead and put myself in presenter view, and we can go ahead and get started. So what is everybody hoping to learn today or hoping to get out of this today? I'd like everyone to at least put one thing in the chat or unmute yourself if you're not shy and share something that you're hoping to learn. And then we can really zero in and focus on those topics and hopefully make things more interactive and helpful for everyone. So don't be shy. I have no prizes to give out, so nothing for the first person who offers something. How long does it take? How long? Go for it.
Okay. Hello, everyone. My name is Jacqueline. You can call me Jackie. And I am here. I believe I'm here because I'm wanting to understand more about how credit, like how the whole building your credit process works.
Okay.
Like, there were some things that I wish I knew before I did some of the things I did. Mm-hmm. And so now that I'm at the place where I'm trying to rebuild my credit, it just seems like it's really difficult trying to get the preliminary $300 or $500 limit cards. It just doesn't seem to be working either. So I'm just here to grasp a better understanding of what is required to build credit, how to maintain while you're building. Mm-hmm. And on the real estate side, I'm hoping that at some point I can get my credit score up to that place where I now qualify to do, to get my, what do they call that, pre-qualification letter? Because nobody wants to talk to you before you have that. So, and one last thing, how credit affects, how your student loans affect your credit, even if you don't have any other consumer debt. That's it.
Okay, lots of good things. Lots of good things. We've got some other things. Financial empowerment was eye-catching. How to maximize and increase credit score the fastest. So really resounding on what you just said as well. Tips to bring scores up to that perfect level. Again, looking how to get out of plateaus when trying to increase your credit scores. Understanding how credit scoring works in general. So learning more about how the industry of credit works. So a lot of people, it sounds like, have the main area of focus of building credit and raising scores. So we'll make sure we zero in on that more today, because when it comes to credit, there's so much we can talk about. We'd be here for hours and hours and days. So I want to make sure what we're doing today works for everyone. All right. So why am I here and why am I talking to you today? What makes me an expert to be here in talking about credit? So my name is Ivory Becker. I'm the owner and founder of Incite Strategies. We are a credit repair organization, and we specifically focus on working with our clients that are trying to obtain a home. So anybody that has a goal of home ownership, tends to come to us, and we work very closely with our partners like DC Lending, and then all of our real estate partners that have joined us here today as well. We also place a very heavy focus on credit education, both to professionals and to consumers. So really to everyone is basically what that says. So I spent over a decade working for one of the largest banks in the country, where my role was managing the adherence to the laws and regulations of default, modification, foreclosure, and short sale processes, and understanding how the changes in the industry from the financial crisis impacted banking and impacted credit reporting. So it gives me a really special insight into exactly how collection companies work, how creditors and those collection agencies communicate with the credit bureaus, and all of that. So I am also a licensed financial planner. So a big focus of what we do while working with our clients is looking at their financial picture and how we can help better that, and not just at the credit score, because everything is really intertwined. Credit is really just the forgotten aspect of your financial balance sheet. So by the end of 2021, we were able to remove almost 8,000 negative items from credit reports for our clients. And this year so far, we're at about 2,100 items, which is about 19 items a day if we were to average it per day. So we're really good at what we do. And our goal is to help you understand more about what's possible when it comes to credit, and then answer all of these questions. So we'll focus pretty heavily today on credit building. So I want to start by looking at the credit score ranges. So most everybody has the goal of getting to this 800 or higher, this excellent stage or range of a credit score. What's important to know is whether you're at the mid 7s or 800, you have pretty much the same lending opportunities that are available, and the 800 just takes time to get to. It takes age. Or credit report longevity, if you will. So very good credit score range is anywhere from the 700 to the 799. And James, what's the highest score, or I guess the highest score you would need to get the best possible rates when it comes to a mortgage?
Yeah, so a lot of people generally think that it's going to be, if I have a 780, I'm going to get a better rate than if I had a 760, but most of our lenders actually consider A-tier credit to be 740 and above. So while it's great to have the 800 credit score, it's actually not going to make a difference on what rate you get in regards to credit. You know, other things can make a difference, but credit won't be a factor past 740.
Awesome. Awesome. Thank you, James. We work with a lot of individuals that are anywhere from that 700 range all the way down to the range where we see the 499 and lower. So even if you are someone who is in the 499 or the 500s range, typically with our process, our clients tend to get to between the 700 and 799 within about 6 to 8 months. Now, James, when it comes to minimum credit scores for qualifying for lending, you know, there's going to be, of course, many specifics to that scenario, but what is the minimum credit score that you can see when you go into purchasing a home?
So the minimum, it's kind of funny. There's a true minimum, and then there's the minimum that you actually want. So a lot of loans can start at 580, but the process and the pricing and all the documents and the requirements for doing a loan at 580 I wouldn't recommend it. So generally the above 600 is going to be where you want to be, and then above 620 is going to be a night and day difference. So whenever I'm talking to a client, I always recommend, let's start first with getting you to 620, because you know, loans under that score, they can be done. I just don't feel as good you know, advising that.
Sure. Now let's talk about other types of credit. So I know earlier it was mentioned that it can be difficult to try to secure or get a secured credit card or other types of products to build credit when you have a lower credit score. You're starting at that lower range. And the whole goal is to get here, right? You want to get to that 700 plus range, so that way you have many options available to you when it comes to financing whether it's a vehicle, whether it's a home, whether it's a personal loan to consolidate debt. So as far as rebuilding your credit, we have several options for our clients that are pre-vetted. So our clients are all pre-vetted. You have the ability to obtain a secured credit card with a soft inquiry. So it's not going to be a hard inquiry. And the only time you're not approved is if you're in active bankruptcy. So when it comes to goals of wanting to rebuild your credit, something that we can provide to you is a credit rebuilding plan, which is available on our website just for a one-time fee of $50, and it will give you about 12 different options to rebuild your credit. So I bring that up simply because that's something that was mentioned as wanting to learn a little bit more, but we're going to explore the background of what you can do to rebuild your credit a bit more in the next following slides. So let's talk about the credit score algorithm, because this is the foundation to which everything is built on. If you don't understand the algorithm, which is really just the factors that contribute to creating your credit score, then you really have no starting point, right? So we're going to talk first about what these factors are and then dive into them in more detail. So payment history is the biggest overall factor that contributes to your score. As you see here, 35% of your score. Pretty self-explanatory. Do you make your payments on time? Anything that is considered derogatory, which just means negative, is going to be repossessions, bankruptcies, foreclosures, charge-offs. And a charge-off, just to clarify, is specifically, we tend to see them primarily with credit cards. So if you go unpaid for anywhere from 120 to 180 days past due, eventually that creditor is going to count that as a loss and they're going to charge off the account. When they do that, it means the account is now closed. They no longer accept monthly payments. You no longer have the ability to borrow against that credit card, and that full balance is now due. That may be sold to a third-party collection agency, or that creditor may choose to collect on it internally. So the more delinquent an account is, the more it adversely impacts your credit score and hurts you more severely on this payment history section. Another important thing that I would like to make sure you are also aware of is when something does go into that charge-off status, that creditor can choose to sell it to a third-party collection agency, as I had mentioned. If they do that, and that third-party collection agency decides to also report that account on the credit report, what will happen at that point is now you will have not only just one derogatory entry on your report from the original creditor, but a second one from the collection agency. The collection agency will now have a balance and the prior creditor will show $0, but now you've been hit twice on your credit for one account. So if you're at the point where an account has charged off and you now have the means to take care of it, it can be a good idea to satisfy that obligation before it can be sold to a third-party agency. And often you can settle for less than that full balance. When it comes to credit reporting, it doesn't matter if you settled for less, if it's already charged off, or if you pay the full amount, it's going to have the same impact on your score, and it will help it a little bit if you're paying it when it's with that original creditor. It will not help your score if you pay it when it's with the collection agency. So those are a couple of tips to be aware of when it comes to payment history. So a little bit more about payment history is as you're trying to rebuild, when you're working on rebuilding your credit, focusing on this area can be extremely helpful, right? Because it's such a big factor when it comes to your credit score. So if you're not in a position where you want credit repair, whether it's for affordability or a distrust of the industry, that's fine. But you do want to make sure that you're crowding out the negative information as much as possible by adding good positive information to your credit report. You will have limitations to how high you can get with your credit scores if you have derogatory information on your report. A lot of people with derogatory information have difficulty getting above the high 600s. Sometimes it's a bit lower. It depends on how robust your credit file is, meaning somebody that has a lot of credit history, and a lot of good payment history, but maybe just a tiny bit of negative history may have a better opportunity of staying at the high 6s or even being in the low 700s if they work on crowding out that negative information. But it's going to be rare to get into the 700s that way. So any questions on payment history? It's one of those things we can really dive deep into, but I'm touching on the surface level a bit here. No question? Go ahead.
Yeah, I do. I just want to restate this to make sure it's correct. So you're saying once the balance is sold to a third party, even if you paid it off, it is not going to affect your credit one way or another.
It's not going to help your credit. It's not going to hurt your credit anymore. That is correct. So once it's with that third party agency, really the only way you can see an increase to your credit score is to have that collection removed from your credit report. My one and only exception to that rule is going to be as of July this year, 2022, paid medical collections will now fall off of the credit report. So that's a brand new legislation that was just passed. So that's again only to paid medical collections. You do want to make sure that anything that you are paying, even if it is a medical collection, is valid, right? You do want to make sure that you're not paying something that perhaps is a billing error. Maybe you already paid it. Maybe insurance was supposed to pay it and they didn't, right? There's a lot that goes into interpreting collections, understanding the laws around collections. So if you are in a situation where you have a lot of collections on your credit reports, you don't want to blindly go about disputing them. You really have to understand what your consumer rights are under the Fair Debt Collections Practices Act and Fair Credit Reporting Act. We do see quite a bit on all over the internet, all over social media, a lot of myths, a lot of just a lot of blatantly false information that is spread as if it's very factual or true. I'll give one main example I'll share is commonly we're seeing, and they all come and go as trends, right? But commonly we're seeing a trend go around that if a creditor sells an account to a third-party collection agency, you no longer owe that debt. Completely false. They're within their legal rights to sell it to a third-party collection agency. That third-party collection agency now does own that debt, and you do now owe that third-party collection agency as well. There are a lot more specifics that go into that, how long they can collect, and all of that. But you know, that's my long rambling answer to you. So hopefully I answered your question and then some.
Yes, thank you.
Okay, perfect. And just to clarify too, when it comes to payment history, negative information stays on your report for 7 years and positive will stay on your report for 10 years. So the positive helps you for longer than the negative hurts you.
Question about that. So is there a point after a certain amount of time during the course of that 7 years when the negative item impacts your credit score less, like over time?
Yeah, so the answer is yes, and it's also no. And I'm going to go to this next slide and I'll explain why, and then we're going to come right back to this slide. So the yes is depending on the version of FICO we're using. So what many people aren't aware of, and we're going to come back to the other factors, but for now we'll focus on versions of FICO because this was a great talking point. There are many different versions of the FICO credit algorithm. So each of these factors that we looked at, right, they're all part of these versions, but the way they look at that information is different, right? So payment history, for instance, it's time weighted on the newer versions of FICO, like FICO 8, for instance. So meaning the older that late payment history, the less impactful it is to your score. But that's not necessarily the case with some of the older versions of FICO. On top of that, there's going to be other differences or other nuances. So that each algorithm or each new iteration is based on changes in consumer behavior. So think of a credit score as a risk mitigation tool. What is the likelihood that a consumer is going to be able to maintain their obligation, or said differently, what's the likelihood that that consumer is going to default on the debt? So as consumer behavior changes, like let's say in the past, having a high amount of debt indicated an inability to pay. Having high debt may have negatively impacted scores in the past, but now high debt doesn't say that somebody can't satisfy an obligation. It doesn't say that for sure, right? We have higher mortgage balances nowadays. People have higher student loan balances, right? So that is no longer a true indication for consumers' ability to pay. So the algorithm has shifted and not considered that as heavily as a factor. But maybe high credit card utilization or high credit card debt specifically could be indicative of irresponsible spending. So those are just some examples, but each iteration is meant to consider the changes in trends of consumer behavior to more accurately predict risk for the current climate. Did I answer you? Okay, good. And even beyond talking about each version, we have industry specific versions, which you can think of like FICO 8 right here. Think of that as like your base score. And then think of this versions in auto lending, versions in credit card decisioning. So the auto score is an industry specific version or a sub version of that FICO 8. So instead of looking at everything as a whole, it's looking at what's your likelihood to go past due specifically on an auto loan or specifically on a credit card. So it's really narrowed in scope for that particular industry, because they don't care what you're going to do with a mortgage or what you're going to do with a car loan. They just want to know that what you owe them is going to get taken care of. So what's important to know then, when we come to mortgage lending down here, they are using the older versions of FICO. And it's something that hasn't changed for an extremely long time, and who knows when it'll ever change again. Why this is important for you to know is if you are somebody that is getting ready to go into the mortgage process and you're looking at your FICO 8 score, this score may very well be higher, could be lower, but it's more likely to be higher than your version 2, 4, and 5 in mortgage lending if you have any negative information on your report. Because again, these scores, you can think of them as a little bit more harsh when it comes to anything negative. They judge you a bit harder than these newer versions of FICO, which are a bit more forgiving. You do have the ability as a consumer to look up all of these versions of FICO. And if you're someone who gets your FICO score for free with your credit card, you're probably seeing a bank card score. If you get it free with your auto loan, you're probably seeing the auto versions of FICO. If you're going to Experian.com and getting your Experian score for free, that's your base FICO 8. So none of these are wrong. None of these are better than another. It's just important to know that these versions of FICO are all used for different types of transactions that you do as a consumer. And to take it one step further, and hopefully I won't lose anyone here. How many of you use Credit Karma? Yeah. Okay, a couple people. Probably more than are okay. I see a lot of people starting to raise their hands. So Credit Karma is not a FICO score. It's none of these versions. It's completely its own algorithm. So Credit Karma itself, the weightings, if we go back here to this algorithm, are completely different. They're not the same at all. So your score, it's not a one-to-one comparison. It's never going to be the same. And let's say you are someone who has collections and Credit Karma has encouraged you to pay those collections. You pay them, your Credit Karma score is going to shoot up. Then you come to pull your FICO score. Doesn't matter, where you're going. Your score is lower because guess what? It didn't matter with the FICO score that you paid that collection. So how can you get a FICO score 2, 5, and 4 is one of the questions we just had submitted. I can give you a link to where you can obtain it. You can pay for it on Experian site too, but we have a resource we use for all of our clients called My Score IQ. After we're done here, I'll send everybody a link to it. It's got a little bit of a discount with the link that we'll send you. So you can access all of these scores there, your bank card, your general FICO 8, the mortgage lending scores, all of it. So,
Ivory?
yeah.
I think Janet had her hand up for a question before that last topic.
Go for it. What is your question, Janet? Let me see if there's something in chat that I missed.
Okay, can you hear me now?
I can hear you now.
Thank you. I had two questions actually. If my only debt is I owe 5,000 on a credit card, and I've been paying that down. And of course, I always try to make an extra payment, but sometimes it doesn't, happen. So what is the best way? Should I transfer that to one of those other credit cards that offer a 0% interest rate for like a year, but you have to pay 3% of the amount forward to do that? Or is it better to get a personal loan? What are your opinions on that?
So I think that's a really great segue into the next factor, which is utilization or capacity and amount owed. So you bring up a great point, is if you have credit card debt, what is the best way to tackle it? Because utilization is 30% of your score. So that really just means what's your balance versus your credit limit. So when you carry a higher balance as compared to your credit limit, you're going to see a really big drop in your credit score, especially if you have a thinner credit profile, meaning you don't have a lot of open accounts on your credit or a lack of credit history. So you want to approach it there's a couple different ways you can approach it, right? What is your primary goal? Is your primary goal to increase your credit score? If so, then a personal loan is going to help you achieve that goal very quickly. Because what happens when we talk about utilization, it is only a factor with lines of credit, like credit cards, right? So you have any sort of auto loan, a mortgage, personal loan, anything that's installment, meaning a set payment with an end date, no ability to draw funds, that does not impact utilization. So immediately once you transfer that balance to a personal loan, you see an immediate lift in your score. What are the drawbacks of doing a personal loan? Well, for some people, it can be interest rate, right? You have a higher interest rate. Have you seen credit card interest rates though? They're astronomical, and they're about to increase again with our current climate. And I won't go down that bunny hole, but don't be surprised when you see your credit card rates increase in the next couple months. Personal loan's going to lock you in, which is helpful. You're depending on your credit score range, you may be looking at an 8% all the way to 12, 15% interest rate on a personal loan. So it doesn't feel good to hear that rate, but you're probably going to pay it off a heck of a lot faster than a credit card too, which most people on average, with that payment that they offer you in a credit card, takes about 20 years to pay it off with the payment amount that they give you. It's ridiculous. It's very predatory. Option number two, right? You talked about transferring it to a 0% interest credit card. You totally can do that, but it's not going to help. There we go. It's not going to help this utilization ratio, because now you just have a new credit card with a high balance and it's brand new. So that might hit you a little bit more because now it's new credit with a lack of payment history. Benefit, you're paying no interest, right? But the problem with that is most credit card companies know that nobody pays the balance off by the end of the 0% term. Some people do, but the vast majority of people don't. And that's what they're betting on. And some of those cards, you really have to be careful and read the fine print, because what they will say is that if you don't pay the balance off by the end of the term, that they might tack the interest on at the end. They're not all like that, but you really have to be careful of the terms. Credit cards are extremely predatory. There are some new laws on the fees and restrictions on fees. They make up for it in interest. So just be really careful with those. And we have an entire webinar just on credit cards. So if that's something you are interested in, we have that on YouTube. So whole hour on credit cards. But does that answer your question a little bit? Or
Yeah,
okay.
I definitely think so. Thank you.
Okay, perfect. And then I know we had another question. Let's see. Josh, I think you said you have a question too, right, Josh? Oh, but you're actually Barbara.
Yes.
Barbara, Josh's Zoom.
I'm sorry. Yes. So I had a few questions, but I think I'm going to start with the one kind of forefront in my mind. So I have been rebuilding my score for about 2 years. I have a rather large student loan debt. I moved down here pre-COVID. So a lot of what I'm doing to build and move into home ownership has to do with regulating my debt to income ratio and of course building credit. Since I'm a first time home buyer, my question is more about when you're looking at these older versions of Fico Score. I mean, even if you have the best score in the world and as prices go up, what are we looking at as far as putting down, being able to have more flexibility if you don't have large amounts of income, and being able to get approved if you do have a bit heavier debt from larger student loans and you're starting out in your career and you're not making, bank because you're not 40 or 50?
So I'll say one thing and then I'm going to turn this one right over to you, James. One thing I want to clarify is debt to income ratio does not factor into credit scores. So your income is not a factor in your credit at all. So loan balances versus your original loan amount, not a factor in your credit score. So that's a good thing. Income isn't factored, total debt isn't factored. It's really looking more at utilization. But I think your question is more around the qualification side, but I wanted to throw that out there. So James, I'll let you take over from here and answer that question.
Yeah, absolutely. So I think one thing that people who are wanting to buy homes and trying to get pre-approved worry about is talking to a loan officer too early, because they're like, I'm not ready. I don't want to get in touch because they're going to pull my credit and deny me, and I'll be worse off than I am now. But generally, it's the best thing you can do off the bat, because what they'll do is they probably don't need to pull your credit. Actually, they probably can. At least I know I don't. I can build a scenario and help answer a lot of those questions. So there's not a real clear-cut answer, but there are program guidelines. So as far as minimum down, there are 3% down conventional loans, 3.5% down FHA loans. In some cases, they're down payment assistance loans, but my general take on those is a lot of people are like, I'm a first-time buyer, I'm going to take advantage of a down payment assistance loan, but it usually works the other way. They're taking advantage of you in one form or another, because banks aren't just nice. They're not just trying to solve the housing crisis. They're trying to make some money throughout the process. So I always recommend first-time buyer to think about saving up 3% and then an additional for closing costs. And then as far as the student loan question, there's going to be a couple, depending on what program. If a student loan is in deferment, a lot of people think, oh, that isn't going to count against my debt to income ratio, but the payment works like any other minimum monthly liability. So if it's a $300 car payment, that's going to count on the debt side. If it's a $30,000 student loan, they're going to take 1% of the total amount, and in other cases 0.5% of the total amount, and count that as a monthly liability. So whatever is a monthly liability is going to count in debt, and then whatever you are using as far as income or qualify as far as income is going to go into the income part of the ratio. So really, home buying comes down to 3 parts: income, assets, and credit. So assets covers the down payment, like we were discussing, and then the debt part is just credit and monthly liabilities, and then the income part, going off what you're saying, is there's the income that a person makes, and then there's the income that the lender is going to say, we feel comfortable giving you that income number, essentially. So let's say a person 40 hours a week, W-2, full-time salary, they're going to just take that salary and say divide by 12. That's what we're going to use for your monthly income. If someone starts a business and they crush it for 2 months and start another business and crush it for 3 months, they're not going to feel comfortable until someone has at least a 1 year or 2 year history showing that income. Then they're going to average it use that figure. So the income part is really hard to say without speaking to a loan officer, as well as, you know, the fine numbers. So I would say get in touch with one you know, because it's better to do it as early as possible, because then they'll be able to say and build some scenarios and either pre-approve you or give you a plan. And once you're working that plan, it can move really fast.
You're more likely to get on board with what you need independently versus trying to have a wide net and working on things that you may not, for you yourself may not necessarily need to be working on.
Absolutely. So it's a lot of people only need to do a couple things. But if they're trying to do everything, they'll just get to where they're trying to go a lot faster if a loan officer can give them a target to aim at and then stay in touch every month or two and see how the plan's going. And, you know, there's a lot of times I was like, people think they're ready when they come to me, and I was like, dang, I wish you came to me a year ago, because we could have been in a way better spot now. So don't be afraid to reach out to your loan officer, and that's what they're there for, is to help guide you into being ready.
And I had one more question now, and this one was for Ivory. So you had mentioned, you know, that there, if you have a lot of credit accounts, that can impact your credit score. Now, for a person like myself who only has a 7-year history, what are you looking at as far as how that impacts you? I mean, how would you define a lot of accounts for a short credit history?
Okay, so it's okay to have a lot of accounts on your credit report, and a lot, I mean, basically, it's a combination of how long the history is and how many accounts you have open currently, to determine whether it's a thin credit profile or a more, oh my goodness, my words, or a more robust credit profile. So ideally you want to have 4 to 5 open active accounts with a low utilization if any of them are credit cards. You want to have a blend of installment and revolving. So you want to have a blend of different types of accounts, because this essentially signals that you can, no matter what kind of account it is, you have the ability to be financially responsible and financially take care of your expenses and not overspend on credit cards. Right?
Okay, so keeping some, so here, so and again, I have one additional question from that, if that's okay.
Sure.
I wanted to. So I have 4 cards. I've been, you know, it's boosted my credit rather quickly, especially when I was paying some of them off, you know, per bill and just kind of ending the statement. So you're saying it's a good mix to maybe pay one off, let one revolve, keep, as long as they're under a specific utilization, that showing that you're using them, showing that you're responsible. I mean, is that more of what you're aiming to achieve with credit cards and credit usage?
No, not necessarily. I'm gonna see if I have a slide on it. Sorry, here it is. Okay. So when you have a credit card, it's very impactful to credit scores because it impacts so many factors of the score. Having a 0 balance on your credit card, every single month it's going to report to the bureaus as an on-time payment. You don't have to have a balance for a credit card to help your score. Many people think they have to maintain a balance, they have to use the card every month and pay it off, but that's absolutely not the case. You want to keep the card active, right? But that really means you only have to use it once every 3 to 6 months. You definitely don't have to use it more than that. If you're someone who likes to use your credit card on a monthly basis, ideally you never use more than 30% of that credit limit that is extended to you. So what does that really mean to you? That means when you start building credit, you're often provided a lower credit limit. That could be $200, especially if you had to put down a deposit in order to obtain the card. You're going to definitely start with a lower limit. And over time, you're going to be requesting credit limit increases. So that way you can get to the point where no matter what you're spending, you have always make sure you have the ability to pay it off every month, but it's never more than 30% of that credit limit that is extended to you. So when you are rebuilding, do not think that means you have to spend. Credit card companies want you to spend. They want you to think that you have to spend because they want to make money off of you. But with the algorithm and the way it's made, it rewards you for having the card. So it's about knowing how to use it to your advantage. Here's the other benefit. Because length of your credit history is 15% of your score as well, and a credit card doesn't have to close, you can keep that thing open, use it once every 3 to 6 months to keep that data feed active and keep the account from closing. And now all of a sudden you are someone who's, you know, let's say 10 years down the line, 15 years down the line, you've got 15 years of credit history that's established, low utilization. This is how you get to that 800, right? That everybody wants. You may only see 10 years of the payment history on your report, but the fact that that account was opened in, let's say 2013, is what's helping that length of credit history. So
Okay, that definitely makes sense to me, and I appreciate you clarifying, because I think that's the misconception. You're thinking you have to spend, and I'm a person that I don't like having debt, and that's the kind of funny ironic part about this is you really need debt in order to establish responsibility to get lending. So this is something that I'm glad that you clarified, because it helps me figure out the proper balance. So yeah, that pretty much answered everything.
cool. Yeah, credit scores are based on your ability to pay debt. That's what the score is. Okay, we've got a couple people with their hands up as well. D, we'll start with D, and then we'll go to Janet next. D, I think you're on mute if you're asking your question. Okay, Janet, we'll go ahead and go to you and we can come back to D.
Okay, thank you. I had a question on credit cards. So I currently have 2. So help me understand, please. I just heard you say having 4 or 5 credit cards is probably a good amount to strive for. But if and when I open another credit card, I'll get a hit to my credit score a little bit then, right? So is it worth the risk?
I love you bringing up inquiries, because that's definitely something to touch on. Depending on where you are in your credit journey, you definitely don't need to start with more than 2 cards. When you very first start, I would say 2 is fine. Ideally 2. And if you're someone who started with secured credit cards, you don't want to be opening a bunch, because with a secured credit card, it's meant to be temporary. When you get to the point where you find that credit card that you know you want to keep, that's going to be one that you kind of place all your bets on, for lack of a better way to put it. That's the one you're going to focus on asking for the credit limit increases consistently. That's the one you're going to make sure you don't forget to use it, because you don't want it to get closed. But when you're starting off with something like a secured credit card or an entry-level card, they tend to have annual fees. They tend to have higher interest rates, and they're a little bit more finicky, is the best way I can put it. So you'll keep a card like that for approximately a year, and then you're going to, at that point, open an unsecured credit card. Some secured credit cards have the option to convert to unsecured. So if that's an option for the card you have, you can do that, just convert it. But at that point is when you'll apply for a new card before you close that secured card, get that unsecured card. Hopefully everyone's following me, because it's a lot of secured versus unsecured. And
actually, I'm not. If you could take a minute to.
So
I'm not.
Let's say you have a secured credit card. You put that deposit down, you got that card, and you started to build credit history.
And what is secured, please? What's the definition?
Yeah. Secured is going to be you had to put a deposit down in order to gain access to a line of credit. So someone with no credit history, or somebody that has a lower starting point in their credit rebuilding journey, may have to start with a secured credit card where they put down a deposit, because they may not get approved for an unsecured card. So the deposit acts as that's your buy-in. That's you essentially saying, I know that I look like that I have some credit risk, but I want you to know I have some skin in the game. So they're willing to lend to you, because they're going to say, well, if you put down $200, we're giving you access to a line of credit for $200 to start with. And we may increase that line of credit over time as you show that you're responsible. So that's essentially what a secured credit card is. Okay. So some of those will convert to unsecured and they'll give you your deposit back, and some won't. But basically, first start rebuilding credit, you don't want to start with opening a whole bunch of accounts. No more, 2 is fine. Two credit cards.
And I had one follow-up question, if you don't mind. So if I'm a homeowner, so because that, is consistent, regularly monthly payments that get automatically deducted out of my checking account, does that, because of that large balance in the mortgage and regular payment history, does that take away your need to have so many credit card utilization activity going on?
So not necessarily. You still need both types of debt, installment and revolving, because that's part of the algorithm, is to have that blend. But a mortgage is kind of the cream of the crop of installment loans. It shows responsible lending, because mortgages aren't easy to get, or responsible borrowing, if you will, because mortgages aren't easy to get. So they help your score considerably too, because they tend to have they have longer terms, right? So now you're trying to increase the average age of your accounts on your credit report of open accounts. You're adding to your payment history. So a mortgage can be super, super, super helpful to your credit report overall, but you still have to show that you can pay other types of credit, which is where the credit cards fit in. And then I want to touch on the inquiries as well, because I did mean to go back to that. So inquiries being a concern. Stop worrying about inquiries. That's my message to you, to everyone. Stop worrying about inquiries. The only inquiries are a portion of this 10% of new credit. A portion of this 10%. So I'm going to stand on my soapbox for a little bit with inquiries. Most people see no more than a 5-point impact from inquiries. And you can have 4 inquiries per credit bureau per year with no negative impact to your score. On top of that, when you are shopping around for things like student loans, a mortgage, and an auto loan, depending on the algorithm, it's anywhere from 15 to 45 days of shopping around. It's not going to count against you as more than 1 inquiry. So let's say you go to a dealership and they run your credit at 20 different dealers. This is the one we always hear. And all of a sudden you see your credit report that you got 20 inquiries and you are furious. You are like, you are damaging my credit. Guess what? It's fine. It's 1 inquiry. You're totally fine. And don't let an inquiry dissuade you from getting the right kind of product. What's more important, 5 points that you're going to recover in 30 days, or getting the best mortgage that's going to save you thousands of dollars over the long run? So definitely don't let inquiries stop you from making financial decisions. So there's my soapbox on inquiries.
That was wonderful. And I don't, just one other question, please. And if you want to answer it as you go forward, that's fine. Not sure if it's the right time, but I am contemplating getting a Slate charge card for travel. You can use it on any airline. And so is there a heavier weight to those?
So I don't know enough about the Slate. No, all credit cards on your report are the same. Like they don't even care if it's secured or unsecured. But there's tiers to credit cards. So secured is like the entry level tier. Retail is like the next tier. Your general big bank cards are the next tier. And then the last tier is going to be your hotel cards, airline cards, things like that. So you need to work your way, progress your credit journey further and further before you can move up to the next tier. Otherwise you just may not qualify. So, I'll leave it at that, but our credit card webinar we have on YouTube does talk more about that.
Okay, thank you.
Janet. No, we talked to Janet. D.
Hi.
What was
Hi.
your question?
Sorry, I missed the first time. I was on another call. I have a question, and again, it may be one of those that's kind of early in the session, but if you have, I paid off an auto loan and my credit score plummeted and I was highly upset. But I paid off one and got a new one. So simultaneously, right? So how long does it take for the score to go back up? And do you know why your score would go down, say 40 or 50 points, but once you resolved an issue, it'll only go up 20 points or 10 points. It never goes back the amount that was actually reduced. Because I had that happen with the auto loan. They reported late, was never late. So after me fighting and getting it corrected, it went down a lot, but then it didn't come back up to where it was. So how does that factor in when dealing with auto loans?
Okay, so we got a couple different questions there. I'm going to start with the last question first. After you corrected the late payment, your score didn't go back up. Short answer to that is going to be, I would have to see the differences in your credit reports before and after that instance to know what happened. It was likely something else occurred on your credit report that impacted you, that counteracted the fix of the late payment. But I'd have to look at your credit reports to know. Now, to answer your question on paying off the auto loan and getting a new auto loan, why the heck did your score drop 40 points? So, well, the hard thing, or the really sucky thing about installment debt is once you pay it off, it closes the account, and open accounts are more influential to your credit score than a closed account. But that's not necessarily the reason why. It's just a small factor. The biggest factor is going to be you've now adjusted the average age of the open accounts on your credit report. So if you have a thinner credit profile, so if you're building credit, that's super jarring to your credit score. Now all of a sudden, you have taken that average age and decreased it, and that's dropped your score. You're losing now the monthly payment history too, and all of that. You now have a new account, so the algorithm is like, "Ooh, what's she going to do with this new account? Is she going to pay it on time?" And as you build your payment history, you'll see this category is not really impacted. And you'll start to see more and more positive influence. But the way you can mitigate that, so many people are in that kind of a situation where you had to do it, you needed the new loan. The way you can mitigate that is through some credit building activities. So there's ways you can add rental payment history to your report, utility bills, subscription services, things that you're already paying for, you can put on your credit and kind of fluff it up a bit. And then it'll create less volatility. So really thinking of the less history I have, the more volatile, the more up and down I'm going to see on my score. And you may see that if you monitor your credit, even as you make monthly payments on things like credit cards, if you use that, use a lot of your credit limit every month. So does that answer your question?
It did, but it didn't give me satisfaction.
Well, feel free to reach out to me. I'm happy to give you, after this, I'm happy to give you some more tips specific to you and your report. So.
All right, thank you.
Yeah. All right, let's see. Did I get everyone? Okay, I'm going to lower your hand. Okay. I think we talked on the algorithm a bit. Let me just touch here. Oh, let's talk about looking at your credit scores. Okay, so when you are using credit monitoring services, it is not an inquiry. It does not lower your score. So just a quick point. It's really important to monitor your credit. It does cost you money. You can't really get all of your FICO scores for free unless you go to Experian.com and you get just the Experian score. That's the only exception. Or obviously Vantage, which again isn't your FICO scores. But credit monitoring is important because I can't tell you how many times we see things on the reports that are incorrect, or identity theft, which is rampant ever since the pandemic. But 70% of credit reports have errors. Not all of those errors impact your score, but many of them can. So it is really important to make sure you are monitoring your score. I'm going to run through here and see if there's anything. So quick sudden drops in your credit scores can be caused by the high credit utilization, which we touched on, right? 30% of your score is utilization. So if you are using a high amount of your balance each month on your credit cards, you want to pay it about 2 to 3 days before your statement date. You can see the statement date on your credit card because that is when the bureaus, or excuse me, when your creditor is reporting your balance to the bureaus. So essentially, your balance is reported once a month to the bureau. So whatever it is on the day that they report, that's what's going to show on your credit report. And going into, you know, like let's say you're going to meet James and you're like, I want to apply for a mortgage today. Try not to use your credit cards a month or two going into the lending process, just to save yourself the grief of trying to figure out how to get your balance updated to zero on your credit report in a rush. But that way you can have the highest score possible. Another sudden drop could be caused from a credit limit decrease. Let's say you had a late mark on a completely different account and you pay your balance off on your credit card. They may decrease your credit limit because they saw a late payment and they're trying to protect themselves. They don't want that to happen to them. So credit limit decrease could cause a sudden drop in your scores as well if you have some sort of a balance on that card. Closing a credit card, don't do it. Don't do it. If you're someone, like I had mentioned before, going from a secured credit card and transitioning to unsecured, it's a reality that you're going to have to do it, but open that unsecured card first before you close the secured card. And don't do this when you're getting ready to borrow. So if you're getting ready to apply for a mortgage, you're getting ready to apply for an auto loan, something like that, just don't get rid of, don't close any accounts before you're trying to do that. Janet, you have a question, go for it.
Sorry, I was unmuting. Yes,
no.
I accidentally did close an account, a very small account, and I wasn't, didn't have knowledge that that would affect how you had mentioned it. It cut down my history of good, you know, of credit utilization. And so I did it. And so it took a little hit, not like 50 points, I'd say like 25. So now what is, can you offer me some suggestions how I can start to build up from that? Should I get another credit card or just leave it as it is?
It's hard to be quite frank. I don't know without looking at your report what would be the best solution for you. In some cases, it could be either of those options, but it really depends on what your particular report looks like. In some cases, you may be able to just let it be, and it will fix itself in a couple months. But I don't know without reviewing your particular report.
Okay, is there any buddy, you know, other than a financial planner that you can sit down and they will go over your credit history with you and help you, you know, make decisions that are good for you and your personal history?
So that's what we do actually. So financial planners don't look at the credit report. Part of what's missing in that's part of, so I'm a licensed financial planner. I used to practice as a financial planner. This is part of what's missing in the financial services industry in general is a focus on credit. A financial planner will definitely help you with assets. They'll help you with debt, but they don't necessarily help you with credit score or how those pieces of the puzzle fit into the creation of your score. So,
Okay.
yeah, but you're welcome.
Okay.
I'll send everybody my contact information after this and we can always sit down and chat.
Great. Will there be a replay of this webinar that we're currently on?
Yes, we will have a recording of the webinar, yes.
Great. And can you also put a link for that webinar that you just addressed credit cards in? Is that possible?
Yeah, I can, we'll make sure that we send that out to you. If I don't, reply back to the email that you get and I'll make sure I get it to you.
Thank you. Okay.
Okay, we already talked about this, so I'm not going to touch on it. Oh, if you have great credit history and you have a sudden late payment, you can see a drop on your score, up to 100 points. Unfortunately, it's something we've seen. If you're someone with a mortgage and you were in forbearance during COVID, and you see that you were marked past due when you shouldn't have, you can fight this. This is I bring it up because we're seeing this every day right now with our client base. So if that's something that you see and you need help on it, let me know. We talked about that. I'm just gonna see if there's anything we missed here? So we actually covered all of these myth busting topics today. So we did excellent. You guys asked excellent questions. Okay. So I had a couple other questions here that we commonly get. I'm going to go through them rather quickly because we're already at the end of the hour. But can cosigning help my credit worthiness? So if you, I'm going to touch on one piece and then I'm going to have James touch on this other half of it. So if you are somebody who cannot get approved for a loan and you can get approved by having a cosigner, that will now add a new account which adds positive payment history to your credit report. But that does not mean that that party that co-signed with you is not responsible for that debt. They are considered just as responsible as you. So said in reverse, if you co-sign to help somebody else, and we see this all of the time, and then that individual doesn't pay that auto loan, it gets repossessed, your score is damaged just as much as that other party. So that's going to damage your credit worthiness, and there's nothing you can do about it. Even if you got divorced, the banks, the lenders, they don't have to honor divorce decrees, so they often won't. Doesn't mean there's absolutely nothing you can do when it comes to your credit report and how to improve your scores. No, just means that it's a valid action that any bank or bureau can take. And James said differently, can co-signing help your credit worthiness when applying for a mortgage?
So it's kind of a misconception. So I know in the auto industry, someone who has a lower credit score can grab someone who has a higher credit score, and they can do something called a blended rate. But in the mortgage industry, how we were talking about the income, assets, and credit that go into pre-qualification, the only thing that a cosigner can help with is the assets and the income part. So someone with a large income can come help the income part of the debt to income ratio, or it doesn't take a lot actually to move the ratio up. Additionally, they can gift and help with a down payment and kind of blend assets. But when it comes to the credit portion, lenders are very conservative. So each person will have 3 scores with the 3 bureaus. So they'll take the middle score, not an average of them at all. So if someone had a 600, 601, and an 800, probably would never report like that, but they're going to take 601, even if another client or the cosigner had 800s across the board. That mortgage is going to be based off of the middle score, whichever one is lower. So clearing that up when buying a house, cosigners can only help with the income and the assets part. Credit, you're kind of on your own.
Thank you, James. Okay, so can you build credit or get a mortgage with an ITIN? So if you are someone that does not have a social security number, but you were given a tax identification number by the government, you do have the ability to build credit and get a mortgage. There are just different specifications to it, and I'll leave it at that, but it is possible. How does adding or removing an authorized user affect credit score? This is a question we get quite a bit. So if you are an authorized user of somebody who has missed several payments on a credit card, let's say, and they remove you as an authorized user, then that can help your score because that will remove the account from your credit report. The opposite is also true. If you become the authorized user of somebody with excellent credit history and a low utilization, it can help your credit score. What is the best solution for someone that has a score of 500 and wants to purchase a home? So to be frank, you can probably get your own score decently high if you have a real strong understanding of credit building. But if you want to get those great rates and those great options, credit repair is the best solution simply because you can remove the damaged credit while adding positive credit. As I had mentioned quite a while ago in the webinar, you can only get so far by focusing on credit rebuilding. It's 50% of the equation. The other 50% is going to be removing the credit damage for anything that's not compliant with the Fair Credit Reporting Act or Fair Debt Collections Practices Act. I'm going to skip that one for now because I think we saw it on the beginning when we looked at the different score ranges. So better credit, better interest. We'll leave it at that. What is the typical timeline for credit repair and how does the process work? I know I mentioned to someone at the beginning in the chat that I would get to this at the end. So I'm finally getting there an hour later. So a typical timeline for credit repair on average for someone in the 400 to 500s is about 6 months to 8 months with an organization like ours. And how does the process work? So if you are someone who is, like we saw in the other question, trying to get a mortgage, if you have a loan officer like James, we give that loan officer access to a portal where they can track your progress. So the second that you are able to qualify for the mortgage, you can transition directly into that process. We set you up with a client portal where you can track your progress as well. And the credit repair process involves our organization contacting the creditors, collection companies, and any credit bureaus on your behalf. And we fight for your rights using those laws to your advantage. There's lots and lots of different laws, and there's not a lot of adherence with the laws. And part of that is because it's up to you as a consumer to know your rights, understand your rights, and then fight for them. You are the only advocate you have unless you hire a resource like us, but I don't see most people on the weekends reading hundreds of pages of the Fair Credit Reporting Act or Fair Debt Collections Practices Act. And those are just the main laws. There's a lot of other regulations we look at in the process. So do we help with removing bankruptcies? I can say we've gotten a lot of bankruptcies off of our clients' credit reports in the past. It is a gray area. So it's going to be one of those items that we may be able to remove off of one bureau, but not the other bureaus. But we're looking for errors. So what is an error? You may be wondering, because I keep saying errors and non-compliance, but not really saying what that is. Let's say, I like to give this example because I think it's very clear. Let's say you have a late payment on your credit card, and you were late in June 2020. And we look at your credit report and we look at a different report, one for Experian, one for Equifax, and one for TransUnion. We want to see the differences across the bureaus. And Experian is showing that it was late in June 2020. But Equifax is showing that you were actually late in July 2020. And TransUnion is showing July 2020 as well. Now all of a sudden we've got inconsistencies across the three bureaus. And you probably also have a statement showing you were never late in July too. So this is evidence to allow us to get the removals off of TransUnion and Equifax, right? You weren't late then. We don't need to tell TransUnion and Equifax that we want them to add a late payment in June. Why the heck would we do that? But the bureaus also don't talk to each other. The information is siloed. And then oftentimes we can go back to Experian and get a removal there too. Sometimes, not always, just depends on what we have and where we're going. Timelines as far as whether they actually investigate it when you want them to, all of that. So it's very intricate. You can think of it as us trying to find that needle in the haystack, and we're experts at finding that needle, and we find every single one of them. And then we have a different set of disputes for each thing that we find in each piece of the law. Hopefully that answered. A little bit rambling, but that's basically what we do. We make things happen for our clients. Our fees, another person asked our fees. We charge $250 for credit education, and then our credit rebuilding plan is built into that. So we have a full platform that includes video education, written content, and then coming July 1st, we're adding about another 6 to 8 hours of video content. It's really, really in-depth, we'll put it that way. So anything you want to know about credit, how it works, we're going to make sure you know every single thing and how that fits into your financial picture. And then we charge $110 a month for the dispute process. So for the process of contacting the creditors and the bureaus. And then we also offer whatever consultations you'd like along the way as well. You get webinars once a month for our process as well. There is a fee of $30 a month for credit monitoring. We have to have access to your reports and know what's coming off your reports. And then every month we give you an update and your loan officer an update if you're working with a loan officer on your progress. So most of our clients end, like I said, within the 700s and are very happy by the end. So I think that's all I have. Let's see. Questions? Any other questions? I think we did a good job asking throughout, but did I miss any questions from anyone?
I don't think you missed, but I want to touch back on this Credit Karma.
Yeah.
So if they're using a different algorithm, I mean, are they legitimately a credit bureau? How do they stack up against the other three?
No, so love the question. So the Vantage score itself was actually created by the bureaus, by the big three bureaus. The bureaus didn't create the FICO algorithm. FICO is its own technology organization. So they're separate. And the bureaus just use their algorithm because it's what became standardized. There's a whole interesting history of credit bureaus, but I'll leave it at that. So they came out with that new score model because they want to make money. I mean, that's literally what it's for. The way the credit bureaus make money is not through investigating, not through, so I'm going to back up a step and this is going to tie into your question. Credit bureaus make money by data, right? A creditor pays the bureaus to report data, right? They pay to report your history. Then the bureaus can sell that data to other lenders, other financial institutions that want access to that data. So they can try to sell you loans or credit cards or whatever. They want that information, right? So all the creation of the Vantage score was another way to do that. And hopefully for them to probably make more profit doing it. Credit Karma, when you sign up for Credit Karma, you are able to, you're essentially saying, yes, you can have all of my data and do whatever you want with it. So they have mastered the ability to get extremely high conversion rates on advertisements for financial products, the highest in the industry, because they have such a high access to data. And now you're opting in to give them that access by using their app. So that's really why Credit Karma exists. And you know, they have great advertising, so everybody uses them too.
I mean, but do the lenders really use the weight?
No lenders use Credit Karma at all.
Okay.
Yeah, you see sometimes for some rentals they'll use a Vantage score. It's not Credit Karma, but they'll use a Vantage score just because it's cheaper for them to obtain. But you can say that almost the entire industry that uses credit scoring uses FICO. It was made to be the industry standard. There used to be hundreds and hundreds of credit scoring models before they made FICO the industry standard. And it was to make lending easier because it was a giant mess before that. What other questions?
So is Credit Karma really a credit bureau?
Nope.
Okay.
It's just just a company that wants to make money.
Okay, got it.
I have a follow-up to the bankruptcy question.
Yeah.
If it just as a scenario, if an item was included in bankruptcy and was discharged off, and then that specific credit card company also places it on your credit report. So it's charged off, it's wrapped up in a bankruptcy court case, and then they go back and they'll put it on your actual credit card. And then it's hard, they won't take it off. How do you get and it shows a zero balance, but it shows a negative impact. How do you get that to take it off of your actual credit?
Yeah, it's a great question. So we have to look, but basically we'd be looking for violations in how the information's reporting, especially when it comes to the bankruptcy itself occurring. So you can see violations in, you know, if it shows charged off or if it shows it was part of the bankruptcy, was it charged off after, pre-bankruptcy. I mean, what's the charge-off date? What's the last payment date that it's showing? You know, there's a whole host of things we can look at on there. So basically, we have to look to know what's possible. We have to look at credit reports and identify the errors that don't fit with the law, because the law says this is how information can report. And if it doesn't comply with how it should report, doesn't matter whether it was your account, doesn't matter if you owe the debt, it matters how the information is showing and whether that is compliant with the laws of how it is supposed to show. Similarly with things like third-party collections, they have additional laws outside of that they have to comply with. So they have to be able to prove that you owe the debt. Most third-party collection companies can't because they buy debt pennies on the dollar. And then what they're doing from there is just trying to collect. They didn't ask for it. May I have that contract so I know that Sally owes that $500? And by the way, where are those extra fees coming from? They don't get any of that because they don't care. They just want to make money. So if they don't have that information, that can help you with not only getting it removed from your credit report, but perhaps also helping you with not owing the debt depending on the violations that are identified. There's a lot of shady things collections will do to try to get payment, like re-aging the account so they can try to report it for longer. Illegal, a lot of illegal things we see with collection companies in general that are very usable when it comes to the credit repair industry. But it's really important to make sure you find someone in credit repair that actually knows what they're doing and actually knows the laws, because unfortunately the industry is also not heavily regulated, right? It should be, but it's not. So anyone can say, you know what, I'm starting a credit repair company and have one. It shouldn't be that way, but it is. So really do proper vetting if you are looking to do credit repair. So yeah.
Okay, thank you.
And then we had another question, and then we'll probably have to wrap up. Otherwise, I'm just going to go all day. But if you still have questions after this, email me. Email one of us. We'll make sure we can all get connected.
Just one quick question.
Sure.
Is it possible? How does, you know, some credit cards advertise, and every month when you get your statement, you get your credit rating. How do they do that? Does that count as an inquiry? Like, how are they privy to that information?
No, so anybody that you have credit with can have access to your credit report. If you see it on your report, it's a soft inquiry. It's not a hard inquiry. Even collection companies, if you have a collection on your report, may look at your credit once a month. So that's not unusual because they're assessing risk to, not the collection, but the credit card company, they're assessing risk. Did she get any new late marks? Is she starting to go past due on other accounts? Does that mean we need to reduce our credit limit, or do we reward her by giving her credit limit increase? So that's why they'll do that. Okay, I paid a charge-off card directly to the creditor. Balance shows 0, it's still there. It's not necessarily an inaccuracy, which was the question, an inaccuracy. Balance should show 0 if you paid it, and if it's a charge-off with that original creditor. It will stay on the report for 7 years from the charge-off. You know, if there's nothing else wrong with how it's reported. And how do you get back your American Express card if it was included in a bankruptcy? You'd have to apply for a new card and see if you can get approved. That would be really the only way. And, you know, they'll have their own internal requirements depending on how long it's been after bankruptcy. But with that, I will leave it at, if you have questions about your own report, we do free consultations. So feel free to go to our website, incitestrategies.credit, or send an email after this and I can send you a link to my calendar. But we always offer those free reviews. We can answer any other questions you have, chat with you about our credit repair process if that's something you're interested in, so we can get you ready for a mortgage, and all of our other partners here can help you with the next steps in the process right after that. So thank you, everyone.
Thank you.
Pleasure meeting
Thank you.
Thanks for the info.
Everyone.
Thank you.